Most people want to see you succeed, as long as it's not more than them. And if you want to retire with millions of dollars in your bank account, there are 7 rules that you need to understand. But in order for these rules to work, there are 3 numbers I need you to understand. TRM. Time, return, and money, because these 3 numbers are going to determine whether you retire rich or broke. I'll show you what I mean. If you have more time on your side, you can build more wealth with less dollars. So for example, if you invest $100 a month and you do that for 46 years because you have the time and you get the average stock market return, which historically has been 10% a year, you'll retire a millionaire. If we focus on the R, the return, well, now if you start with the same $100 a month, it'll only take you 38 years, which means you'll shave off 8 years to build $1 million if you can get a 13% annual return. And if you focus on the money, if you have more money to invest, well, of course, you can build more wealth. If you can invest $500 a month, now in 30 years with the same 10% return, now you can retire with $1 million. So now you can just play backwards. How much wealth do you want, and how much time do you need, how much return do you need, and how many dollars do you need to invest in order to make that work? But that's just the foundational stuff. Now I want to get into the real rules that you need to understand if you want to be able to retire with millions. So let me start with number 1. Only buy what you can afford with cash. Notice how I said that. I said buy what you can afford with cash. With cash doesn't mean that you need to use physical cash. It means you can't buy something if you don't have the money for it. Don't go out and finance that Gucci if you don't get the money for it. And just because it's 0% APR doesn't mean you have the cash. Buy it with cash, and buy what you afford means just because you have $100 in your bank account does not mean that you can afford a $100 pair of shoes. Buying what you afford means, well, buying something comfortably. For me, if it's a luxury that I don't need, I like to follow a rule of 5, which says if I can't buy 5 of them, I can't afford 1 of them. See, there's a difference between being able to buy something and be able to afford something, and in today's economy, it is very easy to be able to buy whatever you want. You can buy things to make you look rich. BMWs, fancy clothes, fancy vacations, because everybody's got lines of credit to extend to you. But when you do that, you are making somebody else rich so you can look rich. Everybody wants a secret sauce on how you can make millions of dollars, but the reality is you gotta have money, put it aside, and then grow that money. That way you can build wealth. And the only way that you can do that is if you don't spend all of your money, and that means you gotta keep some money and maybe downsize some of the expenses. That way you can actually live within your means so you have money to invest, which brings me to number 2. Rule number 2 is prioritize assets over liabilities. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. Your vacation is a liability. Your clothes are liabilities. Your car is a liability. And yes, when I say buy things with cash, I want you to buy your car with cash as well. The only exception with this would be your home. But now, if you want to build wealth, like what I just said, you have to prioritize the investments, the assets, things that are going to put money into your pocket. There's a couple hacks that you can do here, especially if you're getting started with investing. Number 1 is buy what you're already spending money on. So this is not financial advice, but if you're spending money at Apple, buying AirPods, buying iPhones, well, then you could use some of that money to go out and buy the Apple company. If you're going to spend $1,000 at Apple, spend $200 buying some of the company. Just like that, before you go out and buy a home to live in, think about buying a rental property first. And you might say, well, Jaspreet, how am I supposed to do that? Well, there's also ways for you to house hack. I mean, you can buy a duplex, live in one unit and rent out the other. Or you can buy a home to live in, and then after a year, you can move out and rent that home to somebody else. It's all about being clever, but the goal is you got to prioritize the assets over your liabilities. Now, the other part that you want to pay attention to here is not overpaying in fees, because small fees on your investments can also destroy your portfolio. For example, if you're working with a financial planner, you have to pay fees. The problem is most Americans have no idea of how much money they're paying in fees. For example, do you know how much a teeny tiny little 0.85% fee is going to cost you over your career? It's not going to cost you $10,000 or $100,000 or $500,000, but it can cost you over $1 million in fees. By the way, if you have a 401k, you're also paying fees. That fee is called an expense ratio. So you might want to take a couple minutes after this video to go and check what your expense ratio is on your 401k funds as well. But I have some good news, because with our sponsor Facet, you can work with a team of licensed certified financial planners, CFP professionals, who are not going to charge you a percentage on your assets. Instead, they'll charge you an affordable flat membership fee. That means you don't have to pay a commission to their team of planners, and you don't have to pay fees based off of how much money you invest invest, and there's no minimums on how many assets you need to get started. Facet is working to help guide you through pretty much all aspects of your financial plan, starting with career benefits to retirement planning to investing and more, and it's all included in your membership fee. And the best part of all is that Facet is waiving their $250 new member enrollment fee. So if you want to learn more and see how you can get started with a Facet membership, I got the link to how you can learn more and do that down in the description below. The third money rule is that your time is valuable. Here's a fun exercise you might want to try next time you want to buy something. If you wanted to go out and buy this $3,000 very nice watch, and let's assume that you make $20 an hour. See, the real cost of this watch is not $3,000. The cost of your watch is 150 hours of your life plus tax. And this is where you got to decide. Is this watch worth the 150 hours? But that's not all. See, time is one of the most valuable tools that you have when it comes to building wealth because it gives your money time to grow and compound. And what I mean by that is, well, Warren Buffett's wealth really grew and accelerated after his 50th birthday. He was rich before 50, but after 50, he became incredibly wealthy. And the reason why is because now he had a lot of money that was working for him. And this is where the more time you give your money to compound and grow, the wealthier you'll become. See, the thing when it comes to investing is when anybody starts investing, you're not going to have a lot of money because you're just getting started. And so year one, you don't have that much money working for you. Year two, not that much. Year three, not that much. Year four, a little bit more. Year 10, now you have a significant amount. And now when it comes to year 10, well, now you have a lot more money working to grow. A 10% return on $100,000 is a lot more money than a 10% return on $1,000 because 10% return on $1,000 is just $100. But a 10% return on $100,000 is $10,000. And a 10% return on $1 million is $100,000. You might have heard the saying that if you can double a penny every single day for 30 days, you'd have $5 million. But the interesting thing is, if you just add one more day, now you have $10 million. If you add one more day, now you have $20 million. You can start to see that when you have more money working for you, you can grow that money a whole lot faster. But in order to have that, you got to let your money grow in the first place. This is why time is so important, because if you don't give yourself time, you're never going to get the real big rewards. And those real big rewards only happen after you've given your money time to compound and grow. And now, once you've built that wealth, now growing that wealth can grow a whole lot faster because you have more money working to grow. Remember, 10% on $1 million is a lot more than 10% on $1,000. But in order to get to that million, you got to give your money some time to compound and grow. Money rule number 4 is those who are prepared build wealth. You might have heard me talking about the importance of being financially prepared. And in my game, financially prepared means having a savings cushion to protect you against an emergency, but also having cash aside to be able to capitalize on opportunities. So let me start with the cushion to protect you, because the reality is sometimes things will happen. Your company might go bankrupt. You might lose your job. Something happens to your business. Something happens to your kids. Something happens to you. Something happens to your car and you need money. If you don't have any money saved up and you got to go into credit card debt, it's like taking 10 steps backwards. But if you can work to put aside some savings, that's not working to grow and build your wealth. It's there to protect you. Well, now when something bad goes wrong, because eventually something bad will go wrong, you have some cash there to fall back on. If you lose your job, you don't have an income, well, you don't got to go into debt because you still have money to eat. But the second part of being prepared, this is where the real wealth is built, is you have this cash to be able to capitalize on an investment opportunity. When the 2020 pandemic hit, people didn't have money, and it was sad. But the reality is the people that had money and were financially educated were able to make a killing. I was able to buy stocks for pennies on the dollar because the stock market was crashing so fast, but that only was there for the people that had access to money. When the 2008 crash happened, it was the same thing. The people that had money were able to buy stocks for a huge discount. People were able to come in and buy real estate at a huge discount. I started buying real estate in 2011. I was buying real estate in some areas for 90 cents off, 91 cents off, because, well, nobody was going out and buying. Now, I'm not saying this to brag, but what I'm saying is if you can prepare when times are okay, it can give you the opportunity to capitalize on investment opportunities when times are not okay, because the reality is markets go up and they go down, and people always get blindsided when the economy goes down. People always get blindsided when the markets go down, and then they panic and then they freak out, and then you see a lot of people just selling out of fear. But that also creates opportunity for those who are prepared And that means you got to prepare when times are okay. Because what's interesting is when I talk about these things, when bad things happen, everybody says, well, how am I supposed to have money now? Well, you don't start preparing when a bad thing happens. You got to start preparing way before the bad thing happens. That way, when a bad thing happens, you can then come in and capitalize on that opportunity. Money rule number 5 is don't get your money advice from a gym bro. And what I mean by this is everybody has an opinion on what you should do with your money. And every time I go into the sauna nowadays, I feel like somebody's talking about the next stock you should buy, the next cryptocurrency you should buy, the next thing that's going to make you very rich. It happens all the time, which is fine, right? You want to talk about these things, it's cool, but I want you to understand that your money is your decision. And you shouldn't now go out and just listen to a random person because they're telling you that they think that this stock is going to double in the next 6 months. Because if it doesn't, it's you who loses the money, not them. And so now, if it's your money, you got to be willing to do your own research. Every single person has an opinion on how you should invest your money and how you should save your money and how you should earn your money and what type of job you should have and what type of business you should run and how you should run your business. The reality is, if it's your money, it's your decision. And if you want to make smarter decisions, you got to stop letting the world decide. And that includes what's happening on Reddit. That includes what's happening on those online communities. You got to make your own decisions and stop letting the news manipulate what decisions you make, and start making smarter financial decisions by building your financial education instead of just letting the hype and the emotion and the greed and the panic dictate how you invest your money. By the way, this also includes your banker as well. You don't want to ask your banker how big of a home you can afford or how big of a car you can afford, because their answer is always going to be bigger. Rule number 6 is if you can't track it, you can't optimize it. If you're not tracking where your money is going, I want you to start doing this weekend, and I promise you it's going to change the way that you use your money, and I don't even have to tell you what to do. It is an instant change, because when you see what's happening with your money, you're going to want to start changing it. So what you want to do is get a Google sheet, get an Excel sheet, or a piece of paper. I don't care which one you use, but what you're going to do is on the top of this piece of paper or document, you want to write down how much money you're making and where this income is coming from. So if it's your job, if it's your business, write them all out here, separate line items. That way you know over the last month how much money you made and where the money came from. Then below that, you're going to write your expenses. Now this one is a little tedious the first couple of times you do this, but it's going to get a lot easier once you get into the swing of it. Get your credit card statement, get your debit card statement, pull out your bank statements, and I want you to write down how much money you spent at each place. Now you can start to see why this takes a little while, but after you do this, I promise it's going to get easier. Once you write this out, if you have a Google sheet or Excel sheet, if you want it to look a little bit nicer, organize them by category. How much money did you spend on your housing expenses? How much money did you spend eating out? How much money did you spend on groceries? How much money did you spend on clothing and apparel? And on and on and on. Once you organize that here, I want you to write down how much money was left over. Now, below that, write down how much money was invested and where, how much money was saved and where, how much money was given to charity and where, and any other line item of what you did with your money. Now, as soon as you do this, I guarantee you, you're going to want to make a change with what you do with your money, because you're going to see where your money is going and where your money is coming from. Maybe you're going to realize you spent way too much money at restaurants. I've been there. Well, now you might want to start changing that. Maybe you realize maybe you should stop shopping at Whole Foods. Well, you can start doing that. Maybe you see I got to spend more time on one business idea instead of the 14 business ideas that you're trying to run. Well, now you'll see that. But now at least you'll see where all your money is going. And if you see that you have no money going here into investments, you don't have enough money going into savings, well, now you can start making adjustments here, because this is your financial statement. Every single business has to do this, especially an established business. This is called an income statement. It shows you your income and expenses. And the reason why is because in business, what they say is if you can't track it, you can't optimize it. It's the same thing in your personal finances. If you don't know where your money is going, there's no way you can work to improve it. So start with this. It'll take you a couple hours the first time you do it, but I promise you this is going to be the best 2 hours that you spend the entire month financially. And money rule number 7 is you got to learn the rules to money. Because the reality is our economic system is designed to benefit the financially educated and the wealthy, and it's at the expense of the unfinancially educated. What I mean by that is our system is designed to breed consumers and employees. That's what it does. But our system benefits the investors, the entrepreneurs, and the people that understand how money works. Because guess what? Consumers are the people that are spending money at businesses. That benefits the business owner, the entrepreneur, and the investor. doesn't benefit the consumer. I mean, yeah, you get that Gucci watch, you get the Gucci belt, but that ultimately benefits the Gucci company and the investors in the Gucci company because they're the ones that are building the wealth. You just look like you're rich. But beyond that, our system also benefits the financially educated because guess what? When you're just an employee, you're also paying the highest tax rates. And I'm saying this as an attorney who's not your attorney. When you are a W-2 employee, you are subject to the highest tax rates and the lowest tax deductions versus when you are an entrepreneur or an investor, now you can qualify for higher tax write-offs or lower tax rates. Now, I'm not saying it's bad to be an employee. In fact, most people should be employees. Most people should not try to start a business. However, nobody should only be an employee. If you live in a first world country like America, you have to be a business owner. Now, I'm not saying go out and start a business. What I'm saying is you got to start at least investing in businesses because you can invest in companies on the stock market, you can invest in real estate, you could do whatever you like. And now, as soon as you start investing some money, you become an investor. And when you become an investor, number one, you start benefiting from the way that our economic system works because when you're an investor, you own a piece of something. You own an asset. If you own one share of the Amazon stock, you're one of the owners of the Amazon company. So when people shop on Amazon, you benefit. But the second thing now is you also get to benefit from our tax code as well because our tax code incentivizes investors through lower tax rates and higher potential tax write-offs, depending on what it is that you're investing in. Of course, you want to talk to a tax advisor in your area, a licensed tax advisor to know what is right for you and your personal financial situation. But in order for you to benefit from our economic system, which benefits the financially educated, you got to know what's happening in the system. You got to understand the rules. Because if you don't understand the rules, you're going to keep living through the system, just being an employee, spending all of your money, wondering why you never have a chance to get ahead. Our rules are there. But in order for you to win, you got to know the rules in the first place. Imagine trying to play a game of football without a helmet on because you don't know how to play the game. You got to understand the rules of money if you want to be able to build wealth. But that requires you to start investing in your own financial education as well. Now, if you got some value out of this video, I would love it if you could hit that thumbs up button, subscribe to this channel, and share this video with somebody who you think will get some value as well. You can use OPM, other people's money. Use somebody else's dollars to then invest. That way now you can pay them back a little bit of interest, and then you get to keep the profits. But when it doesn't work, that means now not only did you lose your money that you put into your investment, but now you still owe these people back their money plus interest.